As a dividend investor, you probably value good passive income and you want higher yield dividend stocks because you're getting more value for your money. In this video, I'm going to tell you about 3 dividend stocks and 1 dividend ETF that all give you dividend yields in about the 5 to 11% range. I want to give a couple quick disclaimers before I start the video. Dividends with higher dividend yields tend to be a little more risky. This is not the case all the time, but it's a good general rule of thumb. The higher the dividend, the maybe riskier the company is. I want to also say that I have all the stocks currently that I'm talking about, but they are probably the riskier side of my portfolio. I'm not a financial advisor. These should just be suggestions for you to go and do your own research on. This is just an idea video. Now that's over with, hello, my name is Jack Murphy, and in this video I'm going to go over high yield dividend stocks. The highest yield in this video is a little over 11%. Now there obviously are stocks that give you more than 11%, but I don't think there's a lot of high quality stocks that giving you over 15% dividends. Even 15 is pretty high, but like once you get up there, you know, it's hard for a company to maintain that payment consistently and for a long amount of time. So those are generally not great companies to invest in, but I think in the 5 to 11% range, you can still find some good companies. The first stock is 3M at a dividend yield of 5.31%. They have 64 years of dividend growth and a 5-year growth rate of 4.09. 64 years of dividend growth makes them a dividend aristocrat. 4.09% 5-year average isn't terrible, but it could be better. 3M hasn't been going up lately. They're down 24% in the last year and about 7% year to date, which isn't great, but that could be a better opportunity to buy if you were thinking long term. The second dividend stock I'm going over today is Altria Group, MO, with a dividend yield of 7.82%. Altria Group has 53 years of dividend growth, also making it a dividend aristocrat, and a 5-year growth rate of 7.7%. Altria Group sells tobacco and nicotine products like cigarettes and Juuls, which I obviously do not recommend anyone do. They're not good for your health, not good for your lungs, but a lot of people do use them, and Altria Group is going to make a lot of sales, probably for the next generation, because who knows when people will stop doing that. So they will be paying that 7-8% dividend rate for the foreseeable future. Altria Group are down a little, where they're down 6.4% in the last year and 5.6% year to date, which could be a good buying opportunity if you want to accumulate some for the long term. Their PE ratio is 9.52, and that is generally a good PE ratio if you are trying to buy some more. So if you do your research and decide you do want to buy this company, now might be a good time to start. The next stock is Verizon, and they have a dividend yield of 6.49%. They have 18 years of dividend growth and a 5-year growth rate of 2.06%. Verizon is like a telecommunications company. You know, you get your phone, Wi-Fi, and data from them. They provide wireless and wireline connection across all the United States and other parts of the world too. I personally use Verizon for my phone. It's not going away. You know, as the world becomes more digitized and everything else online, we'll all have a greater dependence on the cellular networks and these companies that provide that service. Verizon is down 24% in the last year. They're up 0.25% in the year to date. They have a PE ratio of 8.55. Obviously do your own due diligence, but if you do decide that you like Verizon as a company for long term, now doesn't seem like a bad point to start dollar cost averaging. And finally, Jepi, the Jepi Morgan covered call ETF, they give you a whopping 11.15% dividend yield. Because Jepi is an ETF that is younger than 5 years, they have no 5-year growth rate and no PE ratio. In May 2020, the Jepi ETF started, and since then they've been doing pretty well. They've been serving their purpose as a good passive income asset where they've been paying a high dividend consistently. JP Morgan is one of the biggest banks in the world, and they've got a lot of professionals managing this portfolio. It is 131 stocks picked by JP Morgan's risk-adjusted ranking. They make money by selling S&P 500 index call options, and that is what they use to pay their monthly income. If you want to put a small percentage of your portfolio into Jepi to get good dividend monthly income, I don't think that's a bad idea. Definitely think you should do more research about the ETF on your own before you decide to do that, but I think it is a great idea to look into. Once again, the higher dividend yield stocks tend to be a little more riskier because the more they pay you, the less they are reinvesting into their company. Just be careful. Don't get into a dividend trap where the dividend looks really high, but the company sucks and you lose all your money to price change. That's all for today. Peace.